Hello class, this is Demetrius Wilson again with Managerial Accounting. Welcome to week 9. You are finally here. It goes by very swift for me. Hopefully it went by very fast for you as well. So we're going to talk about how our operating budget's created. And every company needs an operating budget. You need to designate where money is going to need to be applied to in order to have a successful business. So you want to understand how operating budgets are used for planning and control. So we plan, this is what our plan and our objectives and goals are, and then we control by implementing certain fixtures throughout the organization. So what is an operating budget? This budget is a plan of resources, the resources needed to achieve the organization's goals. These are things we need to be successful. We obviously don't want to plan to be unsuccessful. Operating budgets focus on the daily operations of the organization. Operating budgets serve as a roadmap for achieving organizational goals. An operating budget is a short term, remember this, short term, typically 1 year, used for planning and control purposes. So you want to understand the process used to establish budgets. And it all starts with the sales budget because we have to know and understand how many we believe that we are going to sell, whether it's widgets, cars, apples, whatever it is. If we know how much we plan to sell or we expect to sell, then everything else kind of falls into place after that. So what is the top-down approach to budgeting? Well, there are two approaches. You got your top-down, you got your bottom-up, right? So top-down says, hey, we're upper management and we're going to tell you how the budgeting is going to go. We don't really want to relinquish any power. So budgetary process is driven by upper management with little input from other employees. And you can see if you're those other employees, how that may turn you off in regards to how things are done within your company or your business unit. These budgets are imposed on the organization, and employees resist implementing these budgets. Well, why do they why do they resist implementing them? Well, they resist implementing them because they weren't a part of it. They say, I'm the subject matter expert. Why didn't anyone talk to me about this? What is the bottom-up approach to budgeting? Well, this is the opposite. This requires involvement of various employees within the organization, not just upper management. So these people are the subject matter experts. They figure out what's going on and they say this is what we need to budget for. Now, I'm not going to say that this is the only way that works because you can just as easily have people at the bottom who want to request to have, like, let's say, additional people just so they can be comfortable in their work processes, but it's probably not necessary. This approach can be time consuming, but it increases employee motivation and acceptance, and that makes all good common sense. So, what is a budget committee, right? So, a committee for anything makes decisions. So, a budget committee supervises the budgeting process. Most organizations have a budget committee. Budget committee is responsible for overseeing and approving the master budget, right? So, you have one a main budget that everything rolls up to. Master budget is a series of budgets, series of a budget scheduled outlining the organization's plans for the upcoming period. So what budget schedules are included in the master budget? Well, you see right there at the very top, like I told you, there goes sales, right? And then everything else is driven off of sales. Selling administrative, meaning how much you're going to pay as far as salaries go to these salespeople, marketing people, and administration. You have to pay out HR as well. Sales also determines and dictates production, so your direct materials, direct labor, and your manufacturing overhead all determined, all have a direct correlation or connection to what's sold. And then capital expenditures as well, and we'll see a short section on that. Then it all rolls down to the income statement, cash, and balance sheet, all of which we will discuss. So you want to develop the components of a master budget. Well, how do I do that, right? I've done it before, but if you've never done it before, that's the question that you would ask yourself. How exactly would I do that? So what is the starting point for developing a master budget? Well, sales budget is a starting point, and that's just how it works. It provides an estimate of units of product that the organization expects to sell times the sale price per unit. It's typically the most important budget, and it drives all of the other budgets, right? So that sales budget drives all the other budgets. If you say you're going to sell 1 million, you only end up selling 100,000, then yeah, there's going to be a problem, and because they're going to look back at the budget, find out where they got those figures from, and they're going to go after the individual who provided that information. So here's a nice little color picture. Where do we get information from our sales for our sales estimates? Well, from the sales staff, because the sales staff says, "Hey, I know better than anybody how things are reacting in the marketplace." Market research is another way, and then the economist is usually going to have a pretty solid answer. So the sales budget, example for Jerry's ice cream. So let's say sales in unit, 1 unit equals 1 gallon to make things pretty easy. The sales price per unit is $6, right? So $6 all across the board. And the sales revenue is 240,000, 288,360, and 312,000, right? So when you look at that, you say, okay, our sales price per unit is going to be $6. All right, so that's constant. If you look at the diagram below, you see the $6 is always going to remain constant. What is not constant? Well, what's not constant is the fact that we're going to sell 40,000 units, 48,000, then 60,000 and 52. Well, if you're wondering why you're going to sell 60,000 in the third quarter, you'll see a little bit later it's because a lot of ice cream is sold during that time period. So you just multiply the sales in units times the sales price, get 240, 288, 360, 312, with a total of $1,200,000 made. So what does a production budget tell us? It provides an estimate of units to actually be produced. It's based on expected sales plus estimated or estimate of desired ending finished goods inventory less beginning finished goods inventory. So this is your calculation, this is your equation. But remember this, and this happens on all of these slides, on the beginning, that beginning should be over here. So when you look at this, it says units to be produced, right? That's what we're looking for. Units to be produced equals expected sales in units, right? And plus desired units of ending inventory, meaning like let's say I need 10% of the upcoming month's inventory saved, and that's what you're going to get. And then minus units in the beginning, right? So if you have these units in the beginning, then you don't have to make any more today, right? So that's our equation. Shows it aesthetically pleasing. It's a little bit better in the book and kind of gives you a straightforward version of what's accepted and what's not. So here's a production budget example for Jerry's ice cream. Right, so we see we have our $40,000 in sales units, 48, 60, and what's that? 52. But if you look back, there are those numbers right there. So that's where they got those numbers from. Right. Then add desired ending finished goods inventory. So you say, well, why is this 4,800? It's 4,800 because they're saying that they want 10% of the next quarter's sales. So so you have your 4,800 and it comes from there, right? So when you look for 4,800, it's 10% of 48,000, and that's what you're going to have as far as a desired ending finished goods inventory. So you have your sales in units, 40,000. You have your desired finished goods inventory, 4,800. So your total finished goods inventory needed is 44,800. Now, when you deduct beginning finished goods inventory, which you need to do because that's how many we already have on deck. So you subtract your 4,000 and then you have 40,800, right? Easy way to come up with the actual calculation of all of these and then obviously roll up to the total. So what does a direct materials purchase budget tell us? It provides an estimate of the raw materials needed to achieve a desired level of productions. I want to make 5 million laptops. What do I need? Obviously, if I'm a small firm, I'm going to need to increase my business and increase the amount of individuals that I want to hire. The starting point is a number of units of finished goods to be produced each quarter, which comes from the production budget. So you see how these things are all connected, all attached. So answer the question: how much material must be purchased during the first quarter to meet production needs, and what will it cost? Well, you say, well, first quarter we don't have any quarters before it. Well, you take a look back to the fourth quarter to get that. So here's our same PowerPoint, which I said I don't like, but if you just listen and explain properly, you will understand it. So materials to be purchased. that's going to equal materials needed in production and desired materials ending inventory. So and then you have minus your actual materials inventory, and that just means, hey, how many do we already have? So let's look at this in layman's terms. So materials to be purchased, right? So how many widgets do we need to purchase? Well, you have materials needed in production, right? So let's say that amount 70 plus the desired materials in ending inventory. So if you haven't already come up, with that number, you have your desired materials in ending inventory, and you're going to say, okay, I need 5,000 widgets, right? So you have how many you need to make because that's how many you need to sell. Then you have that and one problem is 10%, the other problem is 20%. We have how much we're actually going to need once the quarter's over. And then we have our materials beginning inventory, and that's how many do we already have left over. So if I need to sell 100 of ABC widget, right, and I have 90 already at my facility, then uh, then then do I really need to create 100 widgets? No, I don't. You have to understand that the higher your inventory, the less that you will have to produce. But we're also talking about money, time value of money, timing of issues. So you're not going to just say, okay, well, I'm going to get everything and throw it in the warehouse. So our direct materials purchase budget, right? Example for Jerry's ice cream. So same type of thing. These budgets are all connected and they tie together. So you have your units to be produced is 40,800, and then you have materials required per unit. So or per pound is times 2, right? So it's not just the 40,800 that we're dealing with. We're dealing with that times 2. So materials needed in production is 81,600. And once we get that, we take our added desired inventory, which is 19,680. And so we're looking at the fact that we have materials needed inventory is 101,280, right? But then we want to deduct our beginning inventory. How many did we already have? And that brings us down to 84,960, which is not the hugest of differences. Then you have your cost of materials per pound. You've already done that equation, so you have your $1, and that's 84,960. All right, so same thing all the way on down the line. Just remember when those arrows are pointing that way, that means that you need to steal some information from from the other quarter. So what does a direct labor budget tell us, right? So it tells us, hey, who needs to work, how long do they have to work, all kind of things like that. So it provides an estimate of direct labor hours and related costs necessary to achieve a desired level of production. What's my level of production? Let's see, and this is how much labor I need to get there. It is the second of 3 supporting production budgets, and it tells you how many direct labor hours will be necessary to achieve the planned level of production and the related costs. So here's our direct labor budget example for Jerry's ice cream. Same type of thing. We know that we're pulling these numbers from from prior slides or earlier on in your book. So we have your 40,800 times 0.0, and that's our direct labor hours per unit. And so can't be frustrated or mad at that equation or number that they came up with for that. So total direct labor hours needed in production is 4,080, and our labor rate per hour is $13. Almost at 513, thinking the dollar sign was a 5. But so we have our 4,080. Those are our labor hours, and then we have our $13 per hour. And we come up with direct labor cost per unit. We have 53,040, 63,960, 76,960, 66,560, which all equates to 260,520. And our direct labor cost per unit is going to be $1.30. And you will see why those small amounts actually come in to play a little bit later on. All right, so we're on slide 22, running out of time for our first lecture. So, tune back in for chapter 9 lecture for the end of the chapter, for the end of the course. But this will be lecture part number 2.